Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. As always, probably more excited than my portfolio is feeling at the moment. It's been...
You're telling me.
It's been, well, yeah.
My leverage is, whoo.
It's been a volatile few days, really at the end of a volatile few weeks. Really volatile. How long's Trump been president?
Q1.
But look, we'll talk about that. We'll talk about Liberation Day and what it meant for Australia. We're also going to celebrate a 50th birthday of a company that deserves to be celebrated. We're going to talk about some of the stocks on our watch list, some of the companies we've heard from the interviews and the episodes and the research we've done over the past month. And then we're going to close it out with a community question on defense stocks and defense ETFs. So another big episode of Equity Mates. Let's get into it.
News and markets.
Well, Ren, we've obviously got to start with Liberation Day, Trump's global sweeping new tariff policy that he announced in the Rose Garden at the White House.
The Make America Wealthy Again
Yes.
event in the Rose Garden,
Yeah.
Unless you have, the brackets, unless you have stocks.
Unless you have stocks, yeah. So what did he do? He imposed a 10% tariff on all trading partners except Canada and Mexico. And then from there were many double-digit tariffs imposed across a number of major trading partners as well.
Yeah, I mean, China was, 34%?
Yeah.
Vietnam was 90% or 94% discounted to 47%. A lot of countries got the 50% discount.
Yes.
Yeah.
So to run through it, you're right, 34% went to China. The European Union got hit with 20%, Vietnam 46%, Taiwan 32%, Japan 24%, India 26%. So a lot of double-digit or at least 20-30% tariffs on a lot of countries.
Now, I want to say for Australia, I feel like we got off pretty easy because in the weeks leading up to it, Peter Navarro was singling out Australia. They called us like backstabbers or backflippers about the aluminium. You know how we got the exemption under Turnbull, and then they said we flooded the market in the US.
Yeah.
Trump bloody called us out in his speech in the Rose Garden around the Australian beef industry, and for a
Yes.
moment we thought that Australian beef was getting banned because Trump said Australian beef imports would be banned, but then that fizzled. I read the pages of the trade representatives report. They did a 350-page report on barriers to trade, and I read the Australian section, and they were calling out our pharmaceutical benefit scheme. They were calling out our media bargaining law. They were calling out just a number of our biosecurity laws, and then we only get hit with the global minimum, the 10%. So why do they make so much noise about us?
Yeah, well, we're just this little country down in the bottom of the world, so we'll
that's
see.
Hosting more and more of their military hardware.
Yes. But look, the market reaction was pretty intense. The S&P futures tumbled over 4%, the Nasdaq over 5% when the news came out. So no doubt many Equity Mates portfolios were hurting.
Yeah. I think, like, for me though, if we put our investor hat on and we put our long-term investor hat on, it's not changing how I'm investing. And I think that's probably the important takeaway. It's that, everything we speak about the power of long-term investing. It's survived
The wall of worry.
the wall of worry, yeah. And specifically, it's survived trade wars before. We look at the Australian, we always talk about the long-term performance of the Australian stock market being about 13% a year with dividends reinvested. That looks at the All Ordinaries back to 1900. And we've had trade wars in that time. I mean, famously during the Great Depression, the US had their Hawley-Smoot tariffs that massively raised trade protectionism and plunged a stock market. Well, it was one of the factors that led to a stock market fall becoming a global depression. Now, I'm not saying that history is repeating or rhyming even, but I'm just saying that I don't know what I'm saying. I'm saying I'm just going to keep dollar cost averaging, I guess. I don't want to be alarmist.
Yeah.
I don't think we're close to, depression.
Well, the thing is, we've seen even over the last 3 months that Trump does this and then there's negotiations that go on behind the scenes, and this might not be the end of the story. So
yeah, that works both ways though, because
absolutely,
because it's also like, you know, all these 50% discounts.
Yes,
that's going to become a point of leverage for him.
100%. Well, U.S. Treasury Secretary Scott Bessent has urged nations that have been slapped with the tariffs to just leave it there.
Yeah, don't retaliate.
Don't retaliate.
Get out here.
Leave it there. We'll call it a day. And he said, as far as negotiations go, we will see. But it's going to be fascinating to see how countries react to this news.
Yeah. Well, look, I'm going to keep dollar cost averaging. I'm certainly going to be globally diversified. I'm not going to have all my eggs in the US basket. And I'll be watching with interest. But look, I think another news story that we wanted to celebrate, a bit more positive news story, and a reminder that companies are what drive markets over the long term, not politicians.
Yeah.
Is that Microsoft turned 50 on Friday.
Yeah, happy birthday to Microsoft. Huge, the half centenary. Put the bat up.
Half
century?
century?
What did I say? Centenary. Half century. Now, if you'd invested $1,000 in the IPO back in 1986, today you would have a healthy $4.2 million nest egg.
Yeah, not bad.
That is a compound average growth of 18% over 50 years.
Yeah. So, you know, that Microsoft and its peers are what led to the exceptional decade in America, the exceptional few decades in America, not macro forces or, you know, political decisions. So that it's an important reminder that finding those great companies or buying an ETF that includes those great companies and letting them grow is where the power of the stock market comes from. But I thought it would be good to share some of our favorite Microsoft stories because I think we've got a few.
Yeah.
So the starting point for me is Steve Ballmer, who was you look at his numbers and I think revenue tripled and profit doubled under his leadership when he was CEO of Microsoft. But he's universally seen as a pretty lackluster CEO. They kind of missed a couple of key technology cycles. His story for me is fascinating. So he's now worth over $100 billion. Yeah. He owns the LA Clippers.
Yeah.
It's not like he was a founder.
No.
But he's done very well out of it. And it's because he was the first commercial person hired at Microsoft in 1980. So they'd been around for 5 years at this point. He was employee number 30. But here's why he's made so much money. His package was a $50,000 salary and 10% profit share.
Yeah.
And then Microsoft exploded.
Yeah.
Because it was 1980, they won the IBM contract to build the operating system. 1981, that launches. 1985, they launched Microsoft Windows for the first time. Like, he got on a rocket ship and was entitled to 10% of the profit.
Profit is wild.
To the point where they were like, this is unsustainable. Like, this is way too much.
Yeah.
It's just like, you're getting too much money.
Yeah.
So that when they incorporated later and he basically used that as leverage. Paul Allen didn't want to give him it, but Bill Gates eventually talked them around. They gave him 8% equity of Microsoft. If he hadn't sold down along the way, today that would be worth $227 billion, which would put him like right at the tippy top of world's most wealthy people.
Yeah. Incredible story.
Not from founding anything, just from catching the right ride.
Good negotiation. Yeah. Speaking of selling down, the same sort of story applies to the founder, Bill Gates. If he's obviously known now to be, through his foundation, giving away vast amounts of his stock, billions and billions of dollars worth. So much so that if he hadn't given away any of his equity, or which was at the time about 45%, it would be worth $1.3 trillion. We would have a trillionaire in society, which is just wild.
So wild. Yeah, the Microsoft story. So Paul Allen, the co-founder, along with Bill Gates, he obviously became a multi-billionaire. He was very private. So he had a house in Lake Mercer in Washington State. He then proceeded to buy the 7 houses surrounding his house because he didn't want any neighbors.
That is wild. I remember New Year's Eve, we were out on a boat.
For
sunrise and his boat went
in
past.
Sydney.
Paul Allen,
it was massive.
Huge.
Yeah. So look, happy birthday, Microsoft. And I think Happy birthday. Yeah, happy birthday, Microsoft. And I think for us, it's a bit of a counterpoint to the first story we spoke about, the story that's dominating the news. Companies and the people in companies are what drive long-term stock market performance. That's what we've got to remind ourselves when Trump and tariffs are dominating the headlines. Spend your time trying to find the next Microsoft, because that is how we'll all... And then tell us about it, because that's how we'll all do well.
If you want to keep up with all of the headlines, make sure you subscribe to our daily newsletter. We'll send you a summarized version of the important headlines from around the world into your inbox every morning, 6 a.m, so you don't miss it. We've also turned that newsletter into a podcast called Headlines by Equity Mates, so make sure you subscribe to that as well. Ren, we have the privilege of speaking to many experts every month here at Equity Mates, of course, all of which do go eventually out onto the show, but we get a bit of a front run of what's to come, and from that we get insight into many different ideas that we note down on our watch list. So this segment, we're going to run through stocks that are on our watch list from March. Because of all the content that we've done here at Equity Mates or read ourselves over the last month. So let's get into it.
So I think there's 7 stocks that we've got here between us. I want to start in London, underappreciated stock market. And this company, I reckon, has been underappreciated. Games Workshop.
Yeah.
You heard of it?
I have.
Yeah. Were you a Warhammer? Were you a Warhammer guy growing up?
I wasn't. I kind of started to... I thought about it because I had a couple of mates who were into it, but then I was like, not for me.
For people who are unfamiliar, it's like a fantasy world where you buy figurines and you paint them and then you can battle them. But we're not here to talk about the game. We're here to talk about the share price performance, because it's been like London's best stock performer.
Yeah.
The past 10 years... 40% compound annual growth rate.
Incredible.
Yeah. James Abella from Fidelity mentioned it when we chatted to him, and I had a look at its financials just because I wanted to get a sense of it. So it's got a 40% EBIT margin. It's got a return on equity of 66%, and it trades at a 26 times price to earnings.
Wow.
Yeah.
Wow.
Even with that past 10 years growth rate.
Second company that came across our desk, Ren, James Hardie, global building materials company, put in a bid for AZEK. Shareholders were unhappy though.
Yeah.
So much so that the company was down 15% on the day of the announcement, down 40% in the past year.
Yeah. And I think the reason that shareholders were pretty unhappy was James Hardie is seen as like a high quality, it's got good return on equity, and it wasn't trading at too expensive a multiple. Whereas AZEK was seen as a lower quality business and trading on a higher multiple. So that's why investors were particularly unhappy.
The thing is, though, it's not a shitty company.
Yeah. So 3-year compound annual growth rate for revenue of 11%, for earnings per share of 16%, return on equity north of 20%, trading 22% in the past year, trading at 23 times earnings. For me, James Hardie is always a company that just had the stink of asbestos on it.
Yes,
like it's never one that I considered.
Yes.
But then, when we did that episode on your superannuation and I saw it in your portfolio,
Stink of asbestos,
and then obviously it was in the news, and just reading about the fundies who are in it, it's like, it's an interesting one. Yeah.
The stink of asbestos.
Well, I mean, like that's fair.
It's true.
Yeah.
It's true. Yeah. That's exactly what that was years ago.
Well, is it? But it's still being litigated.
I think so.
Isn't it? I haven't done my research on that, but.
Anyway, let's keep going. Not so much as a company, but we were speaking to Chris Judd. He's a macro investor, and he was talking about the current market for tin, the commodity, undergoing at the moment some pretty significant global supply pressures. So there's conflict in the Democratic Republic of Congo, which I didn't know provides 6% of the global supply of tin, and also mining operations over in Myanmar, another global supplier of tin, are significantly impacted. So he's expecting some price movement on the commodity for tin.
Hey, you think 6% of the global tin market coming out of the DRC is exciting? You should see how much of the global cobalt market it owns.
What? How much?
Like 70%.
Wow.
Yeah.
There you go. What else, Ren? What else is on the list?
So this one didn't come up in a interview, but I was just reading about this company. Never heard of it before. Have you heard of Watsco?
No.
So it's a US company. It's like a air conditioning and
I'm looking at it now.
Yeah.
Aircon, heating, and refrigeration.
Yeah, it's a bit of a conglomerate now. But the reason I want to talk about it, it has got what I think is the toughest employee share program ever. So you know how in Australia, people who work at Macquarie Bank talk about the golden handcuffs of 10-year vesting?
Yeah.
And so, if they leave within the 10 years, they forfeit some of those shares.
Yeah.
How's this? Watsco have a vesting cliff at 62 years old. So it's not about
time. It's not even time. It's just age.
It's age, yeah.
That's what?
And if you work beyond 62, I think they can even extend it. And so basically the cliff means your shares don't vest over time. They vest, in this case, at once at 62 years old. So if you leave before 62 years old, you forfeit 100% of your shares.
That's ridiculous.
So they are basically saying, like, we want you to be an
Lifer.
employee for life.
Yeah.
We want you to really be committed long-term to this company. And so then I was like, that's interesting.
Is it worth it?
How is that translated to share price performance?
Yeah.
19% compound annual growth rate over the past 35 years.
Okay. Well, fair.
Yeah. Yeah.
But yeah. Plenty of other we were speaking about, anyway, don't worry about that.
Think about the employee that started their career in their mid-20s at Watsco 35 years ago and have worked for 35 years. And so they've got paid their salary. They've been collecting these shares and the shares have been growing at a 19% compound annual growth rate. No way you're leaving that company.
No. That's wild.
Yeah.
Wow. Look, we've said it before, but Google continues to be an obvious play at the moment. I think as the NASDAQ continues to drop, so does the PE.
Well, I think the thing that is interesting for us is it's trading at the same price it traded at in 2021.
Yeah.
But if you look under the hood, its Google Cloud business has gone from 17 billion revenue to 43 billion revenue in those, three and a bit years. Their subscription revenue went from 27 billion to 40 billion. YouTube revenue went from 27 billion to 36 billion.
Yeah.
Like these are decent growth percentages in 3 years. YouTube revenue grew 50% 33% in 3 years.
Yeah. Why is the market not into it?
Self-driving cars, I don't know.
That's also another positive.
No, I genuinely think it's AI. You had this theory at one point
that's true.
That Google search will lose some of its dominance with AI.
I know. I'm a case study of that. I rarely Google on my laptop or desktop anymore.
Really?
Yeah, rarely. The only
I'm
thing
still big
maps,
Googler.
big maps user, obviously.
Maps guy.
But for me, Perplexity now trumps Google.
Okay.
For things like restaurants and stuff, still Google. But I also find on my phone still a Googler because I find the AI experience on the phone not quite as good as, even though they all have apps now, still native Google. But yeah, I'm a case and study. But anyway.
There you go.
Still in the portfolio.
So is it the most obvious play then, given that their dominant business where they have 90% market share is under
pressure?
threat?
Yeah. Well, I think also they've been criticized for not keeping up with the AI development as much. I mean, Gemini is their product and it's actually rated as one of the best LLMs at the moment.
Yeah, I don't use it that much.
Yeah, me either.
Except on Google search, obviously.
Yeah.
Here's the interesting thing though. All of these AI models, if they start to eat into search, will they eat into search ad revenue?
Yeah.
Because no advertiser can advertise. Like even if they lose search volume or lose search market share, will they lose market share of that advertising revenue that comes alongside?
Yeah. Good question.
Thank you.
Yeah, we'll see.
All right. Well, if we're speaking about obvious plays that we've spoken about on this podcast before, I wanted to touch on Eli Lilly.
Yeah.
Because so they have Lilly Direct, I think only in the US, but it's to really facilitate telehealth services for their obesity and diabetes drugs, which is GLP-1s, Zepbound and Mounjaro. Is it Zepbound and Mounjaro for Eli Lilly? Yeah. But they are opening up Lilly Direct for their Alzheimer's drug. God, I'm going to get this wrong. Kisunla?
Kisunla.
Yeah, they don't make it easy, do
No.
they? And so that's the brand name for Donanemab. Again,
Yes.
probably got that wrong.
Could have made it easier.
But in clinical trials a couple of years ago, it showed clinical decline by 35% compared to the placebo and resulted in 40% less decline in ability to perform activities of daily living in Alzheimer's patients.
Love that.
So it obviously doesn't stop Alzheimer's, but it slows the decline. It's now being added to their telehealth services as well.
Nice.
Just like Eli Lilly, it's an
It's a
interesting
leader.
one.
It's a leader.
Yeah.
Yes. Now you wanted to close out with one, a gun maker.
Yeah,
really.
Beretta. Yeah. And this actually is a good segue to our third segment today, which we're going to talk about defense stocks. But Beretta is seen as potentially one of the biggest winners from this like revitalization of European military spending. But I was reading this Forbes profile on the company. 499 years old.
Yeah.
It's up to its 15th generation of family CEOs.
Wow.
15th generation.
Wow.
God, if you get born into that
That's
family,
amazing. You're sorted.
yeah. Well, also like you can't.
Huge expectation.
Yeah, your life is laid out there. But you know, it was talking about how their how the business of gun making works and some of the things they're trying to do, which I found quite interesting. It's very much you know how people talk about the printer being the perfect business? You sell the printer at a low margin and then you just lock people into having to buy ink cartridges over and over again.
Yeah.
Beretta was saying the same thing with ammunition. They're like really trying to push into ammunition to try and do the same thing. But the reason I found it interesting was Beretta is a 499-year-old company and it's worth about $2.5 billion US.
What?
And for me, I was thinking about the cybersecurity company that Google bought, Wiz. In 5 years from founding, it got sold for $32 billion. 5 years.
Yeah.
Just a crazy velocity of wealth creation.
Yeah.
And you compare that to Beretta, who's taken 499 years to get to $2.5 billion.
Well, what's their revenue? Oh, wow. 1.4 billion euros. Wow. Okay. That's... What are they doing? Stagnation? Or
well, it's one of the biggest... I think by some measures it is the biggest gun maker in the world.
Wow. Yeah, but that... Crazy comparison.
Yeah.
Crazy comparison.
So anyway,
wow.
Beretta.
Interesting. Nice.
Yeah.
Well, we love to hear the stocks from you guys. So flick them through, whatever's on your watch list. Come and join us in the Facebook discussion group as well, because that's where we have plenty of conversation going on, all things ETFs and individual stocks. We love hearing from you. We're going to take a quick break, and on the other side, we have a community question from James asking us how we can get exposure and look for investment opportunities in light of all of the defense spending that is going on around the world. So we'll be right back.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Answered.
Welcome back to Equity Mates. We have a question from James.
Mates, I've noticed in a few recent Equity Mates newsletters that several countries are throwing some serious cash into their defence budgets. The UK is adding 2.2 billion, Sweden's going from 2.4% to 3.5% of its GDP. Australia's looking at jumping from 59 billion this financial year to 74 billion by 2028. No doubt the US will be waltzing into this peacocking match with some big numbers too. Seeing this trend unfold, I was wondering if you have any thoughts on satellite ETFs as a way to capitalise on the pump in global defence spending.
Love it. Thanks for the question, James. If you want to ask a question, leave us a voicemail. There'll be a link in the show notes or the description below. We love hearing from you. Love the question, James. But yes.
Hold on. But while we're plugging things, if you want to be like James and keep your finger on the pulse with what's happening globally in business and in markets, much like James, sign up to the Equity Mates Daily email. Link is in the show notes.
All right, Ren. Well, let's get stuck into it. He's right. Defense is the I guess the word of the moment, or the thematic of the moment, outside of obviously global tariffs.
Yeah. And
it's been surging.
Sorry.
And Microsoft's birthday, all of that, yeah. Global defense spending is surging. It's projected to reach $2.6 trillion by the end of this year. US leading the way, $895 billion. Followed by China, $266 billion, and Russia, $126 billion. It still blows my mind, the discrepancy between first and second in defense spending. It is wild.
You want to see something wild? Look at the number of aircraft carriers in the world that the US has compared to like every other nation.
Yeah,
it's crazy.
we are
it's
cooked.
Like,
we are
well,
cooked.
no, we're not cooked as long as we sit under the US security umbrella. And as long as the US doesn't get too cooked. Both of which are questioned in 2025.
It is questionable. But I think the crux of the story here, and James alluded to it, the real story playing out is actually in Europe. We are seeing an incredible acceleration of defence spending over in Europe. The European Commission have a plan called the Rearm Europe plan, aiming to mobilise 800 billion euros in defence spending over the next 4 years, including 150 billion in loans to member states. Germany, they have voted to exempt the defence spending from debt limits, enabling 500 billion euros to be spent and unlimited military investments beyond 1% of GDP. That is a huge change in their stance towards military spending. And estimates suggest a 20 to 30% increase year on year in defence budgets across Europe this year. Germany, France, Poland, all really leading the way. So the question is, like, how do we actually take this information and find some investment opportunities?
Yeah, well, that is in some cases, the $1 million question, I guess.
Yeah.
I mean, you can start with stocks,
Yeah.
and then we can roll into ETFs. And I think a lot of people have been asking this question around stocks because the European defence sector has done well. Rheinmetall, I'll give you one guess what company that comes from.
Sure.
What country that comes from?
Germany,
yeah. Up 124%. Thales up 81%. These are all year-to-date numbers as well.
Yeah.
So, like, Rheinmetall has more than doubled in a quarter.
Yeah.
Thales up 81%. Leonardo up 77%. Dassault Aviation up 57%. BAE Systems up 37%. So what we've covered Germany, France, Italy, France again, and then England to close it out. So all the Europeans are having a moment. The question becomes, what's priced in?
Yes, yeah.
And so you've got to do the work there.
Definitely.
The question for me also becomes, how protectionist will the Europeans get? Because there's no doubt a lot of these European armies want American hardware still. They still want to speak to the Lockheeds and the Boeings and the General Dynamics and the Raytheons of the world. Or will there be some restrictions and they need to buy from Europe?
So in terms of James's questions, what are some of the satellite ETFs? I think the first place to start is to really understand what you're getting exposure to through thematic ETFs, and looking under the hood is incredibly important, because whilst you might thinking you're getting defense exposure, it could be mixed up with aerospace and all sorts of random bits and pieces. So we've had a look at some of the Australian ETFs that specifically have some of the European companies that Ren just mentioned, because obviously that's where the money's being spent, or those are the ones that are benefiting. So 3 here in Australia: the BetaShares Global Defence ETF, ARMR, the VanEck Global Defence ETF, Defend, DFND, and the Global X Defence Tech ETF, DTEC. The BetaShares and VanEck Global Defence all have some of the companies that Men mentioned there: Rheinmetall, BAE, Thales. What did I say?
Men.
Rather
than Ren.
Oh, sorry, Ren. So those 3 are listed here in Australia.
So having a look at those 3 Aussie ETFs, they're all obviously majority US. And I say obviously just because the US is such a big market and that's where the biggest defense contractors are. Of the 3, the BetaShares one is most US, 62% at time of recording. VanEck is 53%. And Global X is 54%. Then the European countries, Germany, France, Britain, sort of come in next in all those ETFs. And then there's like a long tail, like Turkey's got a decent defense sector, South Korea pops up. Israel will be in them all as well. Australia probably gets a run in some of them. I can see in the Global X one, we're 0.1%. You're probably not super bullish on the Australian defence sector.
No.
Although people were bullish on Drone Shield.
Yes, that's true.
Less now. But in terms of the top holdings, like, they all look pretty similar.
Yeah.
I would say the Global X and the BetaShares ones look more similar. Like, it really is like the big defence contractors. The VanEck one has some interesting names in there. So, yeah, just go under the hood of the 3 ETFs and make sure you're comparing them and you're if you want to invest in them, invest in the one that most aligns with your thesis.
Yes. Globally, the US there's one listed in the US, Global X Defence Tech ETF. It's exactly the same as the DTech here. Ticker is SHLD. And then for Europeans, there's the Wisdom Tree Europe Defence ETF, and it's pretty heavily weighted to a number of the countries that companies that we spoke about.
Well, yeah, because it's the European one.
Yeah,
like
that's the OG.
Well, sorry, no. The reason I'm saying that, I think it's confusing. It's like it's focused on European companies, not for European investors.
Yeah. So look, there are plenty of options to get access to this thematic. Ren, you touched on it earlier, but for me, this is like you need to be aware of like the perils of thematic investing because a lot of these announcements have already been made and priced in. Like we've seen the growth of these companies. So you really got to consider like what is going to be that next leg up if you're going to start investing in these thematics now. And sometimes the hype is, I guess, more than the actual underlying fundamentals. Like these big dollar announcements, where is it actually going to be flowing and what is the impact to these companies? So yeah, something just to consider when thinking about these thematic ETFs.
So I want to close by posing the question, is this hack or is this semi? Because I think those two ETFs illustrate the duality, I guess, in these thematic ETFs. Because there's no doubt that this defense spending thematic makes sense.
Yeah.
And there's no doubt where this isn't the end of it. Like the flood of money is going to take years to roll out. And honestly, a number of commitments will probably only escalate because, it's one announcement leads to another.
Yeah.
So the thematic makes sense. The question, is it hack or is it semi, I think is important because hack for me, the BetaShares cybersecurity ETF is an example where the flood of money moving into cybersecurity has been relatively evenly distributed, like not perfectly distributed. There have been winners and losers, but the rising tide of cybersecurity spending has lifted most boats. And so the broad thematic ETF investing a bit in all these companies has made sense there. Compare that to semi, which is the thematic is a massive flood of money in spending in semiconductors. But really, investors would have been better off just buying NVIDIA than buying the Global X Semiconductor ETF. Because sure, like AMD's done well and AMD's growing and like a couple of the other companies have done well. But at the same token, some of them are down. Like ASML is down, I'm pretty sure, from, and it's just like there are themes where it's best to just buy the winner, and there are themes where the benefits will be more evenly distributed, and that should be the question that you ask about. Like, should I just find the best individual stock, or should I invest in the theme as a whole?
Yeah, I think this is a semi.
Interesting. I would have said this is a hack.
Nah, well, if you look at the performance, like if to your point, find where the money's going, who's actually going to benefit. These ETFs are sort of 15 to 25% year to date up. Okay. Which, like, compare that to Europe generally, like it's reasonable outperformance, but not crazy. But you're not getting 124% like Rhine Metal or the like. So it's kind of like,
well, I love
there
that
are
because
major winners.
I love that because we've come on different sides of this issue, so no one can claim that we're giving personal financial advice.
Exactly.
So let's leave it there.
Nice. Well, we love hearing from you. Thank you so much for the question, James. As we said at the top, if you'd like to ask us a question, please leave us a voice note. There'll be a link in the description or show notes. Also, if you take a lot out of what we do, we would really appreciate it if you could spend 60 seconds just leaving a rating and a review on your podcast app, or like and subscribe if you're watching on YouTube. It really helps us get in front of new Equity Mates community members. But Ren, always great to chat stocks. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.